I'm Dana Walsh, and I'm running for Congress in Congressional District 8. My main opponent is Nancy Pelosi, the Speaker of the House. I am talking to Don Campbell, my financial advisor on my campaign. I announced my campaign over a year ago, and in that time, I've had a number of advisors on different issues. However, when this last financial crisis hit, I found that I was totally unprepared to understand this problem. And I didn't feel so bad because it seems to me quite clear that most people in Congress don't understand it either. So I've talked to Don about it, and the way he's explained it to me has really made an awful lot of sense. And I thought it would be really helpful to interview him and to let people get a feeling of how we got into this problem, what the roots of the problem were, and how we can go forward at this point. So with that, I'd like to have Don introduce himself. And again, Don.
Thanks, Dana. Well, my background is I have a Master in Business Administration from Stanford University right here in the Bay Area. And for the last 40 years, I have been involved in business finance, both as an analyst, as a corporate director, as an executive, and as an investor. And that's both here in the United States and in a number of countries around the world.
And when we talked, I was very confused as to where this all started and what the roots of it were. And as I recall, you said it's been a long time coming, and I do recall that even way back when we started, you had warned me that we have some financial problems in this country that people were ignoring.
Well, I think the root problem is excessive use of inappropriate debt. And you know, every loan has a borrower and a lender. And what's inappropriate is different for each of them. And you know, take a lender, like a commercial bank, a bank like IndyMac. This is a bank, the kind of bank you normally think of. It has branches, it takes deposits, and it takes the deposits and it lends them out to other people, maybe for home mortgages, maybe to business. And what's inappropriate for a lender like that is to make loans that it can't absorb the losses from, because every loan has some element of risk to it. And if the loan goes bad, that is, if the borrower can't repay, then the real issue is, can the lender withstand that? From the standpoint of a borrower, it's quite different, but it's the same sort of thing. A borrower shouldn't borrow money that is difficult for them to pay back, that would require a change in their life or the way they run a business. And it shouldn't be a loan that is so large that there's no margin of error. Like for a person, if you lose your job for a few months till you get a new job, would you lose your house? Mm-hmm. So loans should be appropriate for both the borrower and the lender.
I know a lot of people have talked about, certainly here in California, for the last 3 to 4 years, people have been buying these houses way above their means, and they've been getting very short-term financing for their long-term investment. Is that part of the problem as well?
Well, there is certainly that in terms of houses being priced beyond people's means, and they're getting a loan that wasn't appropriate. I.e., it may be a loan for too much compared to the value of the house, maybe too much compared to the person's income. And that would be an inappropriate loan. Those are at the heart of the problem we have now. And it's not just homes, it's also loans on credit cards, it's loans to businesses of all types. See, our problem is we've become an economy based on debt. Individuals, state and local governments, companies, and particularly financial companies, and our national government as well.
Right. Explain to me, one of the things that I found most, not confusing, most disturbing, is the idea of how some of these companies were leveraged and what the appropriate amount of leverage is. Again, that you want to have a certain amount of risk there because that's what you expect in any sort of venture, that there's always a little bit of risk, but that the amount of risk was just totally out of proportion to what was appropriate.
Well, the leverage is the amount that a company might borrow relative to its core capital, that is what its shareholders put in. And so leverage is usually measured as a ratio of the amount of borrowings to the amount of capital. And our commercial banks, a bank like IndyMac, is usually capitalized at about 10 to 1. That is, it borrows $10 for every dollar of capital it has. And that's a pretty high ratio. And what that means is a bank cannot make loans, cannot make too many loans that are risky. Because if it does, it will exhaust its capital very quickly. But the really shocking thing is that our commercial banks like IndyMac are leveraged at about 10 to 1. That's regulated. Then you have the unregulated firms, and these are like Merrill Lynch and Lehman Brothers, both of which have failed. These firms got leveraged 30 to 1. And what that means is for every dollar of capital they had $30 of debt. Another way of looking at that, if 3% of their loans turned bad, or investments, because they made investments as well as loans, they lost all their capital. So they were very, very highly leveraged. That, however, pales into insignificance compared to Fannie Mae and Freddie Mac.
Well, you know, that too is something that I am shocked that people don't understand, sort of the core, how this started in the very inappropriate, it was beyond inappropriate, it was ridiculous loans. I recall them being called ninja loans, which meant there was no income, no job, no assets. And they would lend them over 100% of the value of the house. And with no job, no income, et cetera, there was absolutely no way for them to pay them back. How does the scale of the Freddie and Fannie problem in terms of dollars compare to this huge $700 billion layout?
Well, Fannie Mae and Freddie Mac are two quasi-governmental units. And quasi-governmental means they were actually privatized, and yet they had an implicit guarantee of the U.S. Treasury. And so they were able to borrow money far beyond what they could have done if people had just looked at their assets. People looked at those institutions as being guaranteed by the government.
Now, who was supposed to keep an eye on that? Who is in charge of keeping an eye on those loans and the financial well-being of Fannie and Freddie?
There is a regulatory agency in Washington that has that particular job.
And as I recall, in 2004, I think there have actually been a number of calls to have Fannie Mae and Freddie Mac reevaluated, because this is not news that they are in trouble, that they were in trouble. And I recall in 2004, I'm sure everybody who's watching this on YouTube has seen the YouTube videos of Barney Frank saying they're safe, Raines saying these loans are safe, and the regulators actually being called to task saying, who are you to regulate us, everything is fine. How come the regulators didn't have the power to stop it way back then, 4 years ago?
Well, obviously, you can get political interference in a situation like that, but fundamentally the problem was the leverage that you talked about before. Because what I was about to say was not only you had banks leveraged 10 to 1, and you had brokers like Merrill Lynch leveraged 30 to 1, then you had Fannie Mae and Freddie Mac leveraged 70 to 1.
7-0?
7-0 to 1. And what happens then is you can have no bad loans, because if you do, it exhausts your capital immediately. And if you're making loans of the type you described, whether it's a true ninja loan or just a loan that's made to people whose creditworthiness is not very good, or where the loan is much larger than they can ever pay, then you have a very high likelihood of defaults. There's nothing wrong with making loans like that per se, except that whoever makes them needs to have a lot of capital behind them. They have to be able to absorb losses. That's what I meant when I started by saying the loans need to be appropriate. And so if you're leveraged like these institutions were, there is no room for problems. So when problems begin to show up, then you have massive stress throughout the financial system.
Okay.